everybody, and welcome to the last of my weekly live streams. We literally have hit the point that we have less than 1 week remaining to get your registration in for your chance to win the lottery ticket of a lifetime and get your opportunity to buy a home with 20% of the purchase price being provided by the state of California as down payment assistance. So if you have not heard about this program, this is your education. We're going to spend the next hour diving deep into this program. I'm going to cover everything from start to finish. So for those of you who've been following along all along, you're going to get a refresher course on everything you need to know about the Dream for All program. If you are new, and I am shocked at how many people, I had 7 people reach out to me today that knew nothing about the program, that simply reached out and said, hey, John, I heard about this Dream for All program. I want to know about it. How does it work? So this is your chance to learn everything you need to know about this program, how it works, all of the ins and outs, and the tips and tricks we need to know in order to help you take advantage of this amazing program. So the first thing is the deadline. So the deadline ends Monday, the 29th at 5 p.m. That is not the deadline to send me your application. You need to have your application into me much earlier. Now, will I take people who send me an application on Monday morning? Sure, but I might not finish it in time to get you the pre-approval letter in order for you to get into CalHFA's system and register and get all of the information you need uploaded to CalHFA. So if you happen to be watching this at the last minute and you've got only a day left, you need to both fill out my application by clicking the QR code right above, and you need to start filling out the information at the CalHFA website. So you might say, well, how do I get to the CalHFA website in order to register? Let me show you. So I'm going to share my screen, and I'm going to show you where you need to go in order to get registered. So here we are. So this is the CalHFA website. You just go to calhfa.ca.gov. And right here on the top, you're going to see California Dream for All. And as you scroll down, you're going to see a spot for home buyers right here in the middle. And when you click here, it's going to take you right here to this page. And you click here to register for your voucher. You can start the registration process before you have your pre-approval letter. You just can't finish it. So start your registration process at the same time that you're sending me paperwork, because that way you can be ready while I'm reviewing your paperwork. You're putting your information into CalHFA's website, and you are ready to take advantage of uploading the pre-approval that I get to you as the last step. I'm finding it takes 30 minutes to an hour for you to fill out the information, and it has to be filled out. Everything has to be uploaded, and you have to submit your registration by 5 p.m. on Monday, the 29th. So you're going to want to get started right away. So you're going to go in here and you're going to click register for a voucher, and it's going to walk you through the process of registering. You're going to fill out, look, it's going super slow because, well, there's a bunch of people who are trying to get in there right now. And you're going to click apply now, and you're going to get a username and password, and that's going to be emailed to you. Then you're going to log in and you're going to actually submit your registration. So if you already have an account, you're going to click right here to log in, and it's going to take your information. So here's my login. You don't know my password, neener, just kidding. So you have to have your username and password. You're going to get into the Dream for All portal. I've got a complete walkthrough that I did earlier this month that you can find on my YouTube channel. But you're going to see right here where it says my application status is incomplete. You need your application status to say complete and submitted. And so I'm going to go into the application here that I started. And you're going to click, I think up here on the top is where it says start the application if you haven't already done it. And then once you are in the application, hold on here, edit voucher application. That's where I want to go because I've already done it. You've got to fill out all 6 of these sections. So you got to do borrower's information and adding your ID. You've got to fill out your address information, and you've got to be able to put what your mailing address is, what your home address is. You need to fill out your demographic information. Lots of people have been asking questions about why do they want to know if I have student loan debt? Why do they want to know if anybody served in the military or my race and ethnicity? They're collecting a lot of information for statistical purposes. It does not impact your ability to get selected. It does not impact your chances of getting selected, but they still want to know all of these answers. And then you're going to go into your eligibility information after this. And it's going to ask you to certify that you're a first-time home buyer. It's going to ask you to say, hey, who's my California resident? Who is my first-generation home buyer? And so they changed the answers to make it simple. Yes, you meet the first generation home buyer. And so which one of you is the first generation home buyer? You're putting all of this stuff in here. You're putting all of the information regarding your parents' information. Do you know who your parents are? Are they unknown, deceased, or out of the country? You're filling in their birth date and their date of death. You're putting in all of this stuff in here. And then, oh, by the way, you're uploading your pre-approval letter right here. And then you attest to all of this stuff. So why does this all matter? Because you can do all of this at the same time that you're sending in the pre-approval request to me. So you have got to do both. You've got to get your pre-approval letter and you've got to complete this information, and you upload your pre-approval letter right here in the first section, which says pre-approval. You're uploading your pre-approval letter here. So all of this information has to be filled out. All of this portal has to be finished, and you get to review and submit, and you have to submit this. So all parts must be 100% complete to submit, and you got to press submit before 5 p.m. next Monday night. Critical. Before 5 p.m. next Monday night, you've got to get this done. So this is really, really important that if you have not started the application process yet, you need to click this link right up here. That's going to take you to my application portal where you're going to put in all of your information. Here's the deal. We're out of time to have a consultation. So now is your time for a consultation. If you are watching live and you have questions, ask them in the chat. If you're watching this recorded, ask in the comments section and I'll reply to you. But I don't have the time to sit down and spend 30 minutes or an hour with you asking or answering questions. We have to get you into the portal. So if you're not in yet, you have to take the information I'm giving you in this 1 hour and decide, is this something I think is a good idea? Is this something I think I should do? If you think you should do it, you need to submit the application to me. You need to start the registration on the CalHFA website. And then once I get you the pre-approval letter, you finish the application. Then we will set up a meeting for the first couple of weeks in May. So I've got a calendar preset. I'll have a link that we will send to you that will give you the ability to schedule a time in the first 2 weeks of May while they're in the process of reviewing the applications and picking the winners. And during that time, we'll have a consultation. I'll answer all of your questions about the program, about how we can maximize your purchase price. What if you want to look at scenarios with more or less money out of pocket? Maybe you want to add a cosigner to go to a higher price. All of that can be done after you've submitted your request into the voucher portal. So the key right now is we have less than a week to get you into the portal. Into the portal is the key. If you are already in the portal, I am hearing, and CalHFA actually sent out an email to the preferred loan officer, that they are processing the applications to make sure they are complete. So you may get an email. One of my clients emailed me over the weekend and said she got an email asking for her foster care documentation, proof that she was in foster care. She got that email. She emailed me, I believe, on Saturday telling me that, and it gave her until the 29th to submit that information. Now, that's coincidentally the same day as the portal closes. I think they're given basically 9 days, 10 days to submit the information. So what CalHFA said today is just because you submitted your information into the portal, they are validating your information. Now, this I don't believe is the private investigation process, but maybe it is because they've given some mixed signals, but they're validating your information as they go. And if they have a question, they're emailing you now. So if you've already put your information in the portal, double check your status in the portal to see if it is asking you to provide additional information, because that's critical that you get it back within the timeline that they have given you. Now, I was under the impression they weren't going to ask for additional information except for other than for people who have been selected. Now, that may not be true because they're asking for additional information and the portal hasn't even closed. They cannot select, they will not select anybody yet. So pay attention now to the information, the emails you're getting, double check in the portal to make sure that you don't miss an opportunity to provide them additional documentation. Really, really critical to make sure that nobody misses that. All right, so I want to dive in and I want to really talk about what is the program. For those of you, again, who have no idea what the program is, I'm going to give you a full deep dive. For those of you who have been through this before, it's a really good refresher course for questions you may have once you get your voucher. And for those of you who don't get a voucher, I still want to sit down and talk with you about other ways to purchase a home. This is not the only way to buy a home. As a matter of fact, the Dream for All program is the single best and single most expensive down payment assistance program I have seen in my 24-year career. I have never seen a program better, as far as better being the amount of money it provides to you, and better being how much it decreases your monthly payment compared to not using the program. Never seen anyone better, but I've also never seen anyone as expensive. And so if you are thinking about buying a home and you are saying, man, I can't afford to buy a home at today's prices, I literally am unwilling to do it, and I'd rather stay as a renter, this is for sure the way to go. But if you have the means to come up with enough of a down payment and you're willing to pay your down payment, you're way better off coming up with your own money or using a different down payment assistance program. Why? Because you're giving up a significant part of your equity to the state. So what happens with this program is it's shared appreciation. So when you buy the home, you are getting 20%, up to 20%. Everybody's taking the 20%, up to a maximum of $150,000. So if you're buying a home at $500,000, you make a payment on $400,000, the state provides you $100,000, and that's your entire $500,000 purchase price. Now, if you turn around and you sell that home in 10 years, and the price of that home is $700,000, well, the state put in $100,000 or 20% of the original purchase price. The simplest math is to say the state gets 20% of what you sell the house for. So if you sold the house for $700,000, the state gets $140,000. Now they gave you 100, it grew by 200,000. So therefore they're getting 20% of the growth, or 40,000, on top of the original 100. The math is the same if you simply say they get 20% of whatever the house is selling for, assuming the house went up in value. If the house goes down in value, they get back whatever they gave to you. So you don't decrease how much you pay them if the house went down in value. Chances of the house going down in value, look, it's unknown. The reality is nobody knows where house prices are going to go, but we do know that historically house prices have continued to go up over time, even during periods where prices have dropped significantly. They actually rebounded within 7 to 10 years. And I'm going to show this to you really quick. So I'm going to go to a website, St. Louis Spread. Hold on here. And I'm going to go median home price. I know you can't see it. I'm pulling it up in a second. Y'all are saying, John, I can't see it. You're not sharing it. I'm pulling it up right now. So we're going to see the median home price in the United States. And I'm going to pull this up on a chart right here. Boom, I'm going to smaller. That's bigger. I'm going to get rid of this banner here. Boom. All right. So if you look at house prices over the last, oh my God, this is going back to 1965. And we've got prices going up and they dip a little bit and they come back up. And they're going up and they dip, and they're going up and they dip, and they're going up and they dip, and they flattened out. Like here in 1990, we had a pretty serious dip. So if I were to zoom in on the 1990s, boom, and I were to zoom, oops, move me a little bit here. Hold on, please. All right, let's make this specifically the 1990s. You're going to see that house prices in the 80s leading up to the 90s. Sorry, gang, I'm trying to make this a better view. In the 80s leading up to the 90s, you saw prices going up and up and up. Then they crashed and they stayed the same. And so you had a situation where housing prices fell, and if you bought right here in 1990, you paid $126,800, and if you sold in 1993, you sold for 127. You made almost no money. Like you made next to nothing. And when you count the fees that you took to pay to sell the house, you lost money. But if you go from 1990 to 2000, the property was up to 165,000 from the 126, a significant increase. There's never been a 10-year period. If we were to jump right here into the 2000s, and you'd say, oh my God, John, here we have the run up from early 90s, and it ran up to 2000s, and here we are in the 126, and now it's 180, and it shot way up, and the average home price at the peak in 2007 was $257,000. And the prices stayed the same from 2007 to 2012. We didn't recover. That was a 5-year period where prices had dropped. That is the worst recession for home prices we've ever seen in history, was the Great Recession in 2007. But if we scoot forward a little bit, we notice that by, here we are right here, 2013, prices had hit where they were in 2007. By 2014, they were above where they were in 2007. And people said, that's not sustainable. Really? Because house prices just kept going up from there. So here we are, 2013, 2014. Oh, 2018 hits and everybody says house prices can't go up anymore. Here we go, 2018 through 2019. Prices dropped for a year and a half. But what happened? COVID happened. So we had a flattening right here from late 2017 all the way until 2020. We had a 3-year drop in house prices, and then they took off again. And now we're seeing kind of the same thing. We're seeing where we hit the peak in the end of 2022. So we are almost a year and a half through that peak, and we see house prices drop, but that looks the same as what we saw right here. And they say stagnant for a few years. Looks the same as what we saw right here, and they drop a little bit, but they come back. And so you're sharing with the state with the expectation that over time house prices are going to go up, and they do. History says they do. History says they have gone up over time, and they will continue to go up because the cost of living continues to go up. The cost of renting a home, the alternative to buying is renting. All of you who are looking at this program are renters. If you are a renter, then you are dealing with the significant increase in house prices. All right. And Angel asked a great question. Angel, this is the $1 million question. When are they going to announce the winners? They're not telling us. I'm happy to hear that they're vetting through the actual submissions to get information even while we're waiting for the portal to close. But they've got to go back through. They've got to find 4,000 winners, because they've got 1,700 to 2,000. I'm rounding it up to 2,000. They've got 2,000 winners statewide. And they need to find a backup list, a waiting list exactly the same size. They've got to find 4,000 winners, and the state thinks about half the people they touch that they dig into are not going to meet the first generation homebuyer requirement, which means that they've got to go through 8,000 people to find 4,000. I don't know how long they're going to take. I hope it's only a couple of weeks. My gut says it's 3 to 6 weeks, but I don't know. I wish I knew. I wish they would tell us, but they have not. But we just got to keep hoping that we're going to get the information as soon as possible. So that was a great question. Thank you very much for that question, Angel. All right. So let's talk more about the program itself and how it works. So let me go here and bring this guy right up here. And then let's open this thing up right here. So this is a representation of what happens when you sell the house. So you buy a house for $400,000. You get 100 or 500,000. You get 100 from your lender. Now that money is a bundle. It's a package deal that you are getting. What I mean by a package deal is that you cannot go out and get the $400,000 loan separate from the $100,000 loan. All of the money comes from the state of California. All of the money comes as one bundle from Cal HFA. They determine the rate on the big loan, and they provide you the money on the small loan. You cannot separate the two out side by side. And then what happens is, let's pretend 5 years later, that price goes from 500 to 640. So the state gets 20% of the 640, or what's the state get? $128,000, that's right. Okay, so 640, 20% of that's $128,000. Your appreciation, 140, 112 went to you, 28,000 went to the state. So that when you sell the house, you pay back the 128, but you get 142,000 in equity. Why? Because you paid down your balance. Every single month, your balance went down. It's the beauty of home ownership. It's the reality of why, even if you don't get Dream for All, you need to think about, how can I get into home ownership? Home ownership's a ladder. Once you get on the ladder, you can step up a rung. You can get a bigger home. You can get a better home. It's a lot easier to upgrade than it is to jump in. And so find any way you can claw and kick and scream and fight and bite to get your way into home ownership, because that's what's happened over time for people who have become homeowners. And it's what the state is trying to do with this program. They understand that it's hard for people to break the cycle of being a renter. And so if you've been a renter, your parents have been renters, your parents' parents have been renters, you don't have that generational wealth. There's a lot of people who think this isn't fair, that this money is only provided to first generation home buyers. But the reality is, the state's looking at a way to change the trajectory of families for years and decades and generations to come. And so that's what this is about. And so this program is a great opportunity for you to become a homeowner if you are a first generation home buyer. So let me show you really quickly. Let's scroll through here really quickly and show you what the first generation home buyer rules are. So if I go down here, First generation, are you going to show me that? Come on, bring it up. Why are you not bringing it up? Okay, let's do this. Oh, no. All right, well, I'm going to do it the old-fashioned way. Let's just go through the pages. First generation home buyer means three things. It means you have never had anything to do with a mortgage in the last 7 years. So you, the buyer who is the first generation home buyer, only one person needs to be first generation. That person has to meet all of these criteria. And that is they themselves have not had anything to do with a mortgage in the United States at all in the last 7 years. And that one person, their parents cannot own a home today. Or if they are deceased, they could not have owned a home the day that they died. So the system is very clear. The legislature decided these rules and they said, or decided the first generation requirement. It was Cal Haffa that came up with the rules. They said, look, how do we determine what first generation is? And they realized you can't really look back and say if your parents never owned a home, because if they had to sell their home before they died, then you didn't get the generational wealth that comes from home ownership. Now, some people say, yeah, but my parents own a house and it's a reverse mortgage and it's upside down. Well, they had to draw a line somewhere. And so you have to meet the criteria that you personally, one borrower, has to have not owned or had anything to do with a mortgage anytime in the last 7 years. And both that person's parents, not one, both of their parents need to have not owned a home now. We don't care if they owned a home last week or last month or last year. Your parents cannot own a home now, or if they passed away, they cannot have owned a home the day that they died. There's an exception, and that is if you are in foster care at any point in time growing up, then you have an exemption to the parents' rule of not owning a home today or never having owned a home. So this is really, really critical to understand. The other piece of this is you have to be a first-time home buyer. So a first-time home buyer is very, very different. A first-time home buyer says you personally have not lived in a home owned by you or your spouse anytime in the last 3 years. Everybody on the loan must be a first-time home buyer. Nobody on the loan can have lived in a home anytime in the last 3 years that was owned by them or their spouse. One person on the loan also has to be a California resident. Okay. Now, one of the things that's important to understand is Cal Haffa approves, there's income limits, and they approve you based on qualifying income. So you can kick somebody off of the loan and say, hey, I don't want you on the loan because the income is too high. But that person cannot be an owner of the property. So it's important to understand that, because you cannot have any owners that are not on the loan, and you can't have anybody on the loan that is not an owner of the home. So it's really, really specific how Cal Haffa's rules work. All right, so let's dive into some of the other things about this program that you need to know. So first of all, when do you pay back the state? This is a point of confusion. A lot of people misunderstand. You pay back the state one of 3 times. When you sell the home, when you refi, or in 30 years, you will always pay back the state. You will always, always, always pay back the state. There's no way around paying them back. So when you sell, they use the price of the selling price of the home to determine their share of the equity. Oh, let me go back up. So you the owner, you the seller, pay all of the cost of selling the home, and the state gets 20% of whatever the gross sales price was of the home. So when you sell, they paid 20% in, they get 20% out. A lot of people think, oh my God, that's horrible, they're ripping you off. The truth is they're just a partner. They invested into your business, your home, your investment. They get a share of the money back out of it. So just don't freak out. It's not a big deal. It's not too much money. It's an appropriate amount of money because they are investing into your home. They are investing into your future. They are not, think about buying stock. Okay. When you invest in a business, you have 2 options. You can be a equity holder, a stockholder, or you can be a debtor. You can be a bond holder. Bonds say the business, the company, pays you back a set amount of interest over time. But if the business is really good, you only get the amount of interest that you agreed to. But if you're a stockholder, you get a lot of money if the business grows, and you get only a little bit or no money if the business retracts. The state is an equity shareholder in your home, but you don't have to make payments to them. You don't owe them any interest. You don't have to write them a check each month for that payment. But in return, they're a partial owner. They don't own your home. They're not truly an owner. But from a sharing of the equity perspective, they are an owner. Now, you don't have to decide. You don't have to get their permission to sell the house. You don't have to get their permission to do work on the house. It's your home, okay? But I want to warn you about one thing. Don't buy a home that's a fixer. Now, I know I'm kind of going off track here, but I'm going to cover a lot of different things. So don't buy a home that's a fixer. Why? Because you buy a home way below market value and you put all the work in fixing the home, you only get 80% of what that increased. If you've got a family home that you are buying way below market value, which I have a client that wants to do that and buy a home way below market value from family. And I'm trying to discourage this client from using Dream for All. They said, John, it's the only way I can afford the home. And I said, okay, I understand. But your family is giving you that home for a much cheaper price. The house is worth $600,000 and the family's willing to sell it to him for $350,000. So now, later on, when you go to sell the house, here's the deal. The state's not going to let you sell the house to your sister for well below market value. Okay? Everybody would do that. That's the one way everybody would try and get away from paying back the state is, hey, when I sell the house, I'll just sell it for less because I'll sell it to my sister. And that way, the bank, the state doesn't get any of the equity. They're not going to let you do that. So now you bought a home from your family for $360,000 that's worth $600,000. Now, all those $600,000 homes, they went up by $150,000, which means you would owe back the state on a $600,000 home. You'd owe them back the 20% that they gave you, and you would owe them back the 20% of the $100,000 that went up. So you'd owe them $20,000 in interest in equity share. But you bought this house for $360,000 and it's worth $600,000 today. So there's $240,000 of built-in equity. And when it goes up by $100,000, it's worth $700,000. That means you grew from what you bought it for to what you're selling it for, went from $360,000 to $700,000. That's a $340,000 increase. And the state gets 20% of that. The state only gave you 20% of the $360,000. They gave you $72,000 as a loan. And in exchange, you're paying them back 20% in appreciation on the $340,000. You're paying them back $68,000 in appreciation when the truth is they only deserve $20,000 in appreciation because the property should have started at $600,000 and gone up to $7,000 and you only owed them 20% of that. But instead, you owe them 20% of what the difference was between what you bought it for and what you are selling it for. So don't use this program to buy a house below market value from family because the state is going to get 20% of that discount. Don't use the program to buy a home that you're getting a deal on. I had a client last year who bought a home at the exact same time as Dream for All. He would have been my 10th buyer. I had 9 people I helped. He would have been number 10. I talked him out of it because he was getting a house that was a dump. We barely got it to pass appraisal. We had to do a bunch of stuff to get what's called an escrow repair holdback or work done after close of escrow in order to have it meet conventional guidelines. And he got that house for a steal. He bought it literally for $360,000 and repaired. It was worth about $500,000. And he put about $50,000 in work into it. And so he ended up paying about $410,000 for a house worth $500,000. But the state wouldn't even take into account the $50,000 that he paid to do the work. They simply would say, hey, you bought this house for $360,000 and you turned around and the market didn't go up at all, but you sold it for $500,000. That's a $140,000 increase. We'd like our $28,000. We'd like our 20% of that increase. So be careful using this program to buy a house at a discount, whether you're getting the discount because you know the seller or you're getting the discount because you're buying a house that is under market value and needs repairs and you're going to do all the work on it. The state's getting a share of all of that deal that you created. They're your partner. They're getting part of that deal. So be careful using this program to buy a home like that. All right, let's go back and keep going on when do you pay back the state. So you pay them when you sell. You pay them when you refinance. So you're allowed to refinance one time without pulling cash out. But the second time that you refinance without pulling cash out, by the way, you can refinance really for 2 reasons. To decrease your interest rates and use that lower interest rate to lower your monthly payment or pay your home off faster, or you're pulling cash out is the second reason. Now, if you're trying to pull cash out of the property, the state says you must pay us off at the moment you're pulling cash out. You have to pay our money back at that time with the cash out you're pulling out. So you basically, the state's the first person in line to get cash out of the property. You cannot pull cash out for yourself. You can't go get a home equity loan or a home equity line of credit on the property. Why? Because home equity loans or lines of credit want to be in second position. The state of California is in second position, and technically, their loan is a loan that can grow. There's only a few loans out there that can grow. It's technically called negatively amortizing. The value owed to that lender gets higher over time. No bank wants to be behind a loan that's going to continue to grow because that impacts their security interest in your property. A bank is giving you a loan on a property because they know that the worst case scenario is you can't make the payment and they can foreclose. It sucks. I hate using the F word, okay? But it sucks. The bank gives you a loan because they know they can foreclose. But if the bank realizes, hey, wait a second, this house is worth $500 right now, and you took out $400,000 as your first, and you paid it down to $350,000, and you bought it at $500,000, and you have a $100,000 second, so you owe a total of $450,000, and now the house is worth $600,000. And so the bank says, well, wait a second, there's $150,000 in equity. But that $100,000 you owe on the second is really bigger. We don't know how much bigger yet because we don't know how much it's going to be when you sell the house. So you're not able to go get a home equity loan or line of credit. You're not able to pull cash out of your house until you pay off the Dream for All loan. You need to be fully aware of that fact. So when you refinance, you must pay back the money when you refinance on a rate and term for the second time or when you pull cash out. And at that point, CalHFA is going to order an appraisal or do an online valuation. They are not going to use my appraisal. They're not going to use your appraisal. They're going to do their own to determine what the house is worth, which is exactly the same thing they're going to do in 30 years when you pay off your primary mortgage. You either have to, in 30 years, if you never refinance, some people say, John, I'm just never going to refi. Because if I never refi, I never have to pay back the state. It's not true. Okay, it's not. It's just not true. I'd love to say it's true, but it's not true. CalHFA, the state of California, the government will always get their money. Okay, they will always get their money. And so they are loaning you this money, knowing that at some point in time, you have to pay it back. Now you're going to say in 30 years, how am I going to have the money to write a check to the state for that much money? Well, you have a house that's owned free and that's not owned free and clear, but you don't have a first mortgage anymore. So you just take out a new loan. Okay, 30 years from now, I hope I'm not still doing this, but I've been doing it for 24 years. I'm getting gray. I'm thinking in 30 years, I should be long retired, but my kids maybe will do it. Who knows? Anyway, in 30 years, you go to the bank and you say, hey, can you give me a mortgage to pay this off? And they'll happily do it. But now you have another payment you're making. Okay. So just be aware. If I've got some people who are saying, John, I want to build wealth through home ownership and I want to use this program to do that. That's great. But you're going to owe more money later. And they're saying, but I want to pay down the balance faster. And that's great, but you're going to owe more money later. And so if you have the cash or can get money from family to do a loan without using the state's money, you are definitely going to be better off. By the way, got a lot more people that have joined us live. So if you have any questions about anything, feel free to jump in and ask those questions. This is our last of our weekly live streams leading up to the Dream for All registration portal closing next Monday. And as a refresher, if you have not already gotten pre-approved, you're almost out of time. Click the QR code in the top right corner and you can start the process. You need to get me your information as quickly as you possibly can. All right. So how's the money going to get distributed? This is the next step of what's going to happen. Okay. So the state right now is collecting registrations, and in the collection of registrations, they are figuring out what region you live in right now. Not where you're going to buy, but what region you live in. Now, this is the Dream for All loans done last year. So if you look at this, let's make this bigger so you can see it a little bit bigger. If you look here, you're going to see that the Los Angeles, as an example, 9% of the Dream for All loans went to Los Angeles last year, and it is 25% of the state's population. The Inland Empire, 14% of the Dream for All money went there, yet it was only 11% of the state's population. So they've said that's not fair. The state legislature, the senators have said, it's not fair. The assembly people, they said, it's not fair. We want to get money into our district. And so they said, we got to change this. We got to do something different. And so they said, okay, so this year we're going to give out the vouchers based upon what region you live in. Let's do this so you can see it maybe a little better. There we go. So it's based on what region you live in. So they're estimating 1,700 to 2,000 winners. So you are seeing right here on the screen all of the regions. What do we have? I didn't count them. 1, 2, 3, 4, 5, 6, 9 regions. 9. Got it? 9. 9 regions. So there are 9 regions, and you are in one of those 9 regions based on where you live today, where you lived when you submitted your registration request into the CalHFA portal, and they're asking you to prove where you live. And based upon where you live will determine how many people are selected within that region. Oh, my camera just went dead. Uh-oh, hold on a second. I'm gonna keep talking. You guys can see this on the screen as I am talking and trying to figure out why my camera is dead. Why is it dead? That's plugged in right there. And that's plugged in right there. I don't know why it died, but anyway, let's just keep talking and see what happens. Hopefully it comes back up, and hopefully it doesn't go dead again. And I will get back into the chair, and we will hope that it stays running. Hi, I'm back. Here I am. Welcome. Thank you. All right, this happened to me once before, like back in January when I first got this camera, and I realized that I hadn't charged it, but it's plugged in, so it shouldn't have gone dead. Anyway, they're going to figure out what region you live in right now. They're going to ask you to prove what region you live in, and this is the breakdown of the number of winners per region. Now, I've had people who said, John, I'm in the middle of moving. I'm going to move from Los Angeles County to the Inland Empire. Should I register living in LA, or should I register living in the Inland Empire? It's hard to say. Statistically, there are more winners in Los Angeles, but there's also more people living there. So it's a crapshoot. You need to, A, tell the truth, because if you lie, if you falsify information, they're going to find out. They're going to send you to jail. Okay, they're not going to send you to jail. But they actually have said they will turn over people who are truly falsifying information on purpose. They'll turn them over to the Department of Justice. So yeah, I guess you technically could go to jail. This is what's going to happen over the next few weeks to a month and a half. My guess, 3 to 6 weeks from when it closes in a week, for them to process the background checks. They are going to check. Somebody asked on one of my channels today, I did not have a chance to respond to it, but they said, how are they going to know that my parents own a home right now? Because they've hired private investigators. They have hired a private investigation team to go through and validate. Now, they said they're not going to have the private investigator validate everybody, because that would take forever. They expect over 20,000 applicants. So there's going to be 1,700 to 2,000 winners, and they expect over 20,000 applicants registering. And I have a feeling it's going to be more than that. So you're talking about A, less than 10% of the people who register have a shot at winning based on those numbers. B, there's a lot of people for them to go through and validate through the private investigation process. And that's what I'm worried is going to take time. And they're going to come up with 2 lists. They're going to come up with the list of winners, and they're going to come up with a wait list. If you are on the list of winners, you are given 90 days to find a home. When you find a home and get into contract, that is when we lock your interest rate. That is when you pay for your appraisal fee. That's when you pay for your earnest money deposit. Now, you're saying, John, what are all these fees and how do I pay for them? And can I get an advance against my Dream for All money to pay for them? No, you have to come up with that money out of pocket. And that's part of the strategy that we're going to talk about. So over the next month, I'm going to be doing more and more videos on my YouTube channel explaining these things, explaining the home buying process, explaining everything you need to know about what money you need up front, ways to negotiate to get an offer accepted, because you have 90 days to get an offer accepted. And at that moment is when we lock in your interest rate. So between now and then, rates are bouncing around. They started out at around 6.5 a couple of months ago. They're right now at 7.25. They could go higher. They could go lower. Nobody knows. But your rate is not locked in until you get your offer accepted on a home. And only after that, once you talk to me and we actually freeze in your rate. So you are dealing with kind of an unknown variable. You're dealing with, I don't know where interest rates are going to be. Now, if you want to calculate a monthly payment, I have a really good payment calculator in my app. So if you haven't downloaded my app, download my app. It's got a great payment calculator in there that you can go through and run calculations saying, hey, if I'm putting 20% down and the rate today at CalHFA's website is 7.25, then this is what my monthly payment is going to be. So you can get really accurate numbers, because a lot of the numbers you see online are not accurate. They don't give you proper taxes and insurance, or they're assuming that you're paying the taxes and insurance separately and they're only telling you the principal and interest, or they're basing the payment on an adjustable rate mortgage. There's lots of things they do to play with numbers to make the numbers look better. The reality is the math is the math. The interest rate, the purchase price, your down payment, that's what goes into what your monthly payment is. But remember, you can only put so much money down. You're not allowed to put more than 5% of the purchase price out of your pocket. That's it. So when you look at how much you can put down, I think I have a spreadsheet about this. Maybe I do, maybe I don't. Okay, maybe I don't. Anyway, I do, I just don't have it up. But you can only put a certain amount. Actually, let me see if I do. I know I do. Oh, yeah, it's part of this spreadsheet right here. So you can only put so much money out of your pocket. I'm going to pull this right over here. I'm going to make that bigger. I'm going to make myself smaller. Boom, the miracles of technology. I'm going to make this bigger. I'm going to show you that depending upon your purchase price, if you are, oh, I lost the first tab. Let's go over here. Beautiful. All right. So if you're buying a $500,000 home, then the most you can put out of your pocket is $25,000 or 5%, $100,000 from the state, which means your smallest loan amount is $375,000. You can't put more down than that. That's the most you can put out of pocket is $25,000 of your own money. This column represents how much you can put out of your own pocket. I just broke it. No, I didn't. Okay, good. That's how much money you can put out of your own pocket is the red numbers. So if you're buying a $1 million home, your money from the state stopped growing. You can't get more than $150,000 from the state, and you can't put more than $50,000 of your own money towards down payments. So now you're dealing with the most you have is $200,000 for that $1 million home. Now, the good news is that's 80%. You don't have mortgage insurance. But if you buy a home of over $1 million, you will have mortgage insurance. There's no way around it because it's impossible to put 20% down because the most you're allowed to put down is 5% of your purchase price out of your pocket. You can pay closing costs, but 5% of the purchase price and the $150,000 from the state. And as soon as you buy a greater than $1 million home, you're going to have mortgage insurance. Now, there's multiple ways to pay for the mortgage insurance. You can pay it as a monthly fee, or you can pay it as a one-time fee. Okay, this is going to be fun because my fun little camera is somehow not charging, and so we're gonna wrap this up a little bit sooner if this happens again. Let's try and plug this in somewhere else, guys. Sorry about that. I'm gonna take this guy right here and give me 2 seconds to try and plug it in another spot. The good news is you can still hear me, and you're still seeing the part on the screen that talks about down payment. And in 5 seconds, I'm gonna hopefully get my camera back up and running. Lost a little bit of my light. So let's plug that guy right in there. Oh, all right, lost another light. This is fun, isn't it? The miracles of live television and live streaming. Let's see if that works better. All right, I'm back. Let's see how long I get to stay. All right, so this is the breakdown of the most you can put out of pocket as your down payment. So let's go back here. We talked about the vouchers and how the money is going to work. Am I still bright enough? Yeah, I'm still bright enough. I lost one of my lights, but that's fine. Okay, so now let's finish out here. So income limits. Hey, Billy, good to see you, my friend. Billy says hi. I say hi to Billy. Good to see you, my friend. All right. So you have to be under the income limits for the program. So let me show you the income limits. Before I do that, I got a question. So Durgam, can you pay money over the 5% to buy down the rates? Yes, you can. Should you? That's the $1 million question. Hold on, let me double check and make sure this thing's plugged in really good right there. Yes, it is. Okay. All right. You just got a good close-up of my shirt. Anyway, yes, you can pay more money to put more. Let me say this in a different way. First of all, let me get a sip of water. Where did I put my water? Man, this is fun. Oh, well. I don't have my water. Yes, I do. It's over here. Man, it is just a wonderful evening for me, isn't it? Thanks, guys, for your patience. Yes, you can put more out of pocket, but it isn't down payment money. So don't confuse that. You can put 5% towards your down payment. You can pay for closing costs separately. And yes, you can pay extra to buy down your rates. In general, I don't think it's a good idea because CalHFA doesn't always offer rate buy downs. It's a day-to-day decision, excuse me, on both if they're offering a buy down and how much it's going to cost for the buy down and how much it's going to benefit you. In the few days that I've seen it, it has not been beneficial. So yes, you're allowed to do that. Yes, you're allowed to pay money over the top, but there's a limit on how much you can pay in fees. And so once you start doing more in buy downs, there's a limit from the state of California, not because of CalHFA, because of state finance law that limits us on how much we can charge you in fees. And so there becomes a point when we can't have you buy down the interest rate unless you're using seller credits to buy down the interest rate. So now it starts becoming a creative negotiation with the seller to say, hey, Mr. Seller, I'm willing to buy your house for this price and I'll pay you extra, but I need you to use that extra to pay me back some money for closing costs, not because I need the money, but because the state won't let me use my money. If I was a seller, I'd be wondering if I could just work with somebody a little more simple. And so that's part of your problem, Durgam, is that you're going to be up against sellers you're going to be up against buyers that are competing to buy the same homes that you're trying to buy. I can get super creative. I'm super technical. I understand all of the art of negotiation with lending and how to fit that into real estate and how to structure your offer, how to deal with appraisal gaps. I think appraisal gaps are going to be your number one benefit if you have extra money, because you can write an offer for higher than the asking price. And if the value comes in under, you can cover that 100% out of your pocket, and it doesn't count towards the 5% cap. Because you're allowed to put 5% down payment, but you're also allowed to cover any shortage on the appraisal. So I'm going to talk more in the coming months. Watch all my videos if you haven't subscribed, because I'm going to talk in the next month or so about strategies to get your offer accepted. And an appraisal gap, having no appraisal contingency, is one of the things you can do to make your offer a lot stronger. Having no loan contingency, because we're going to get your loans. Everybody who is a recipient of a voucher, we're going to get their loan into underwriting, so we have a full underwriting approval so that you don't have to worry about having a loan contingency. So if you have extra cash in your pocket, you can use that money to pay for a shortage on the appraisal. You don't have to have a loan contingency because we're going to have your loan fully underwritten. And now the only contingency you need is your inspection contingency. That gives you time to look at the home, to determine with a home inspection, with a roof inspection, with whatever inspections you and your realtor feel are appropriate. And there goes the camera again. So clearly there is something wrong with my camera. I am sorry, gang. I'll turn it back on, but there's no point in running around. So we're going to wrap this up pretty quickly because this is going to go dead. So if you have questions, feel free to ask me questions. I could probably switch to my other camera, but the quality is horrible. And so you're not going to appreciate that camera. But if this goes dead one more time, I'll switch to it. Anyway, the bottom line, I might even make this smaller if I had to. Anyway, so if you have questions, feel free to ask those questions. Basically, you have to be below the income limit. So let's talk about the income limits, because this is something really, really important to understand. And let's share the screen. And I'm going to show you the income limits. So there's two income limits that you need to be thinking about. You have the income limit for the amount of the maximum you can earn, the maximum total that you can earn, and it's per county. And so this list is on CalHFA's website, but this is the most you can make as qualifying income. Now, for some of you that are applying right now, we're going to have to figure out a way to get you pre-approved as quickly as possible without necessarily having a strategy call. And that strategy call, we talk a lot about how do we massage this number. Maybe you need to work more overtime or less overtime to get you closer to the number you want to achieve. But you got to strike a delicate balance between having enough income to buy the price home you want with the payment that that home requires versus having too much income and being over the income limit. And interest rates play into this. I can get rid of Durgam's message here. And I'm getting rid of myself. So we are going to stay 100% on screen. And I'm no longer going to be on the video because there's really no point. My camera keeps dying. So you are looking at the income limits, and interest rate matters because it's all about what you qualify for. And I'm going to show you how interest rate matters by giving you this chart right here. And this chart goes through and shares with you. I'm okay with hiding this one right now. Okay. So that part I'm not worried about. So what this basically says is, hey, if you make $150,000 a year. So we looked at the income chart and we said, hey, in Los Angeles, let's use Los Angeles as an example. So in Los Angeles, you can make $155,000 a year. So if you make $155,000 a year and you have $200 in monthly debts, then the program says you can spend $6,258 a month towards your house payment. Now, these numbers are approximate because I approximated the taxes and insurance, even though at every purchase price, the taxes and insurance are different. Now, if rates are at 6.5, you can buy a $990,000 home and have a payment of $6,258 a month. By the way, if you paid off these credit cards, you can actually buy a more expensive home because now you can afford $6,458 a month towards your house payment. That's a $1,018,000 loan amount. So now what you're looking at is what if interest rates go up? Now interest rates are higher. Right now, CalHFA's interest rates right now, let's get over here. You can see their interest rates every single day. You can go right here to CalHFA's homepage, and right on their homepage, you can pretend that you are a lender. And right here under lenders, it says rates and reservations. So you can check their rates every single day. By the way, guys, we're going to wrap up in about 10 minutes, depending on how many questions we have. And so if you have questions, please post them now in whatever whatever platform you're on, and they'll come through on my end, and I'll be able to pull them up on screen. So right here, you got view today's rates. And every single day, there's going to become a line when they launch vouchers that is going to say California Dream for All. Okay. So right here, JT, I think you were somebody that had a question I didn't answer. So I apologize, but I just saw your question right now. And I think you had another question I may not have gotten back to. But right here, CalHFA's interest rate, CalHFA conventional with a down payment assistance. It's at 7.25 today. Now, if you're considered low income, it's at 7%. Now, what's low income? That means this is the regular income. Low income in Los Angeles is if you make less than $84,000. So you got to be under that limit. Okay. So now you're looking at, if you're over that $84,000, you have to have a 680 credit score. If you're under that, you need a 660 credit score. And everybody on the loan has to meet that minimum credit score. So somebody who makes $155,000 in Los Angeles, they have no debt. They can buy $1 million home, but that's it. You can't go higher than $1 million because in order to go higher than $1 million, you've got to make more money. So if you made $175,000, you can buy a $1.1 million home, assuming interest rates are at 6.5. But right now they're at 7.25. So that loses $70,000 of your buying power. $70,000 of your buying power is lost because interest rates are up by 0.75%. So you will have 90 days to shop for a home. Now, JT asked a question, and I'm going to answer that in a couple of ways. So when you get pre-approved, if you're not yet pre-approved, you need to get it now. Scan the QR code at the top of the screen. And then you need to get that pre-approval. Now, JT, that pre-approval isn't valid for any specific period of time because you have to re-qualify again when you go under contract. We're going to look at your income limits, and we're going to make sure that your income does not now exceed the maximum that you're allowed to make for that county. So just because you were pre-approved does not mean that you meet the income limits at the time that you're buying a home. Now, the income limits are expected to change. CalHFA has not said for sure, but I've read between the lines. I won't explain to you where, but if you're watching my videos, you'll see me talk about this, that the income limits I expect to change probably in mid-July, and I hope they're going to be going up. I'd be devastated, and a lot of you would be devastated if they go down. But CalHFA will make you certify that you are aware that you must meet the income limits at the time you go under contract. So JT, your pre-approval is not for any length of time. Now, a lender, when we use the lender's pre-approval letter, which you don't have yet, any of you that got qualified with me, you have CalHFA's pre-approval letter. That's to get you into the race for a voucher. Once you get a voucher, or if you don't get a voucher and you start shopping with a different program, you're going to get a regular pre-approval letter from me. JT, that letter is good for 60 days. The truth is, it's good for 120. But we put 60 days because we don't want you shopping for a home more than 60 days from now without us making sure nothing has changed. Your credit report is good for 120 days. You have to close escrow within 120 days. But it can take 30 to 45 days to close escrow. Now, we can get it done in as quick as 15 days. But you don't want to be writing an offer on the 110th day for a credit report that expires in 10 days. So that's why your pre-approval letter, once you get a true pre-approval letter, most lenders are putting 60 to 90 days on that letter. Your Dream for All pre-approval letter, isn't really a pre-approval letter. It doesn't have a timeline on it. So JT, hopefully that answered your question. If it didn't, let me know or ask me in a different way, but hopefully that explained it. So guys, you have to meet the income limits and you have to meet the loan program guidelines. So let's go through here really quickly. Talked about first generation, has to be no more than 5% of your own funds up to 150 grand. You can use it for down payment and or closing costs. Use it to increase your buying power or lower your monthly payment. I want to show you what the numbers look like. Now, what's funny is when I created this actually last year at the first Dream for All, I'm using the same figures over again. And what's interesting is these numbers back in January, February was like, oh my God, John, you're showing 6.99 as an interest rate and rates are at 6.3 to 6.5. Well, guess what? They're now at 7.25. So these numbers are low. But if you were doing a traditional loan, the conventional loan with 3% down on a $400,000 home, you need $27,000 out of pocket and you have about a $3,300 a month payment. Okay. If you did that as an FHA loan, you could stretch your buying power a little bit because you can buy around 410 because rates are a little lower on FHA, but you need a little bit more cash to close. But this is where Dream for All comes in because the third option is the Dream for All option. Trust me, that third option is Dream for All with 20% down. You're buying a home, $400,000 loan amount, $100,000 from the state. You're paying your own closing costs. And for the same monthly payment, you were able to buy a $500,000 home instead of a $400,000 or $410,000 home. But here's the cool thing. You can also get into it with no cash needed. You can get into it with almost no cash to close by just increasing your loan amount and drops your purchase price a little bit. And now we're using 4 to 5% of your Dream for All money to pay for the closing costs. Now I'm buying out your mortgage insurance. So you don't have mortgage insurance in here. That's part of the extra closing cost when you're putting less than 20% as a down payment. But this is how having the Dream for All program gives you a lot more buying power, between $70,000 and $100,000 in increased buying power by using this program. Now, if you said, John, I'm okay at $500,000. I just don't want to spend $4,200 a month for a $500,000 home. So how can I use this to make my payment cheaper? Well, if you went to an FHA loan for the same price, you could get a little bit cheaper payment because your interest rate's a little bit cheaper on FHA. But Dream for All is the key. With the Dream for All program, you are $876 a month cheaper at the exact same interest rate because you are simply paying for the down payment through the Dream for All program. And so you're needing less cash out of pocket and you have a significantly lower monthly payment, or you can take the best of both worlds and say, you know what, let's buy a $500,000 home and let's have a payment of about $3,400 a month and need next to nothing out of pocket. So if you make less than 80% of the area median income, you actually get some extra benefits. You have a lower required credit score, you get a better interest rate, and you only pay back 3/4 of the appreciation that everybody else pays back. And if you're putting less than 10% down, you have cheaper mortgage insurance. So let's go through quickly what it takes to qualify. Again, guys, I'm going to wrap up here in a couple minutes. If you have questions, feel free to ask those questions in whatever platform that you're in right now, and I will absolutely answer them. If you're watching recorded, then we will address these after the fact. So you must be a first-generation home buyer. One of you must. It is a conventional loan. So if you know anything about lending, Fannie Mae's guidelines. It's not a Freddie Mac loan. It's not FHA. It's not VA. It's not USDA. It's not a non-QM loan like bank statements or anything like that. You have to be occupying the property within 60 days and continue occupying it for a year. You cannot have non-occupant cosigners, and you must have a few $1,000s to spend because you need to pay for your appraisal, you need to pay for inspections, and you need to pay for earnest money deposit. And the earnest money deposit is going to depend on what the norms are in your market. And so if in your market, they want a 2% earnest money deposit and you're buying a $500,000 home, then you're going to need to have 10 grand as your earnest money deposit. Okay, so just be aware of that fact. Talk to your realtor. 680 minimum FICO score, and your bankruptcy has to be at least 4 years old if it's a Chapter 7 or 2 years old if it's a Chapter 13. And you have to be 7 years outside of a foreclosure unless that foreclosure was included in a bankruptcy. Debt to income ratio can go up to 45%. I won't bother with that because we don't have a lot of time. Conventional limits, it uses conventional loan limits. So each market is different. Some markets are high balance markets Across the state, every market is at least 766, 550. If your loan amount's above that, you get the privilege of paying an extra fee to the state of California because you will pay what's called a high balance fee. So you notice right here, it says high balance loan limit fee 0.933. That changes every day, and that's a fee you're paying in addition to the normal fees for the fact that you have a high balance loan. Okay, you get to pick the property, and it's just got to be a single family residence. It can be a condo, it can be a PUD. You're allowed to have an ADU. You just can't count the rental income. In manufactured homes, you're okay, but you can't go over 45% debt to income ratio. So guys, there's no point. I mean, it's too late. We're not doing soft credit checks. We don't have time to wait and make your credit better. You need to make sure you're saving money for your appraisal and know your numbers. Pick your realtor. It is time to start shopping for a realtor. I'm going to talk over the next month about the process of picking your realtor and how it's all working with all those nasty emails and news articles you've seen about real estate agents and what they charge. And I'll explain the truth about how all of that works. Homebuyer education, don't bother with it. You don't need the homebuyer education to get in on the voucher. You only need it once you have the voucher, and it's 8 hours of education that costs $100 and it's good for a year. So if you did it last year, look at the date. It probably expired because most people did it in April or May, and you have to close escrow within that 1 year expiration date. There's a second one that's online only that talks about shared appreciation. So no rush on that stuff. I won't bother to just buy now. Interest rates. We already talked about costs, so I can kind of skip through this part. Guys, we are wrapping up. So if you are ready to get started, this is the same QR code that's at the top. If you have any questions about anything at all, reach out to us. But here's the deal. We don't have any more time. We don't have time to wait and ask questions. We don't have time to hope that everything starts looking better soon. The reality, and I'm turning on my camera for a quick minute as we finish this out, and my camera's going to go dead. You're out of time. You have less than a week. And so if you are thinking about using this program, immediately you need to scan this QR code. You need to get your information over to us. We are processing your applications as fast as we can. I was talking the last few months about how, hey, schedule an appointment with me. There are no appointments available because myself, everybody on my team, it's all hands on deck on processing the applications to get you through to the deadline. I already heard from Cal Haffa today that some lenders have stopped accepting new applications. My team is working through the weekend, okay? They're going to make sure that we're going to take care of every single one of you that wants to get in on this, but you need to help me help you. You need to give us this information as soon as possible so that we can start pulling all of the information together, and you need to start submitting your information into the Cal Haffa website. Even though you don't have your pre-approval yet, the truth is if I never give you a pre-approval letter because you didn't have good enough credit or income, it only costs you a couple extra minutes of spending time putting your information into Cal Haffa. There's no harm for starting an application you didn't complete. But imagine if you didn't get it started and I get your pre-approval letter on Monday at noon and you don't have enough time to finish putting all of your information in there. So Tony's asking, what is the app called? So my app is Summit Home Now. So when you scan the QR code and you go to, it'll take you to the App Store. You can also go to my website, johnloanking.com, and in the top corner, it'll say apply now. But the app is called Summit Home Now. That is the right place for you to go. That's got my calculator in it, but it's where you start the application. And if you are applying from here forward, even for those of you who already applied with me that we're collecting your stuff, we're not going to do a review meeting. We're not going to talk strategy until after May 1st. We're going to get you an approval letter. If that letter is not what you expected, it's okay. We can change the dollar amounts. We can massage the numbers. You're not locked into those numbers. But if I get you a letter, that is your golden ticket that you can enter into the lottery. That is everybody's number one focus. And unlike my peers who have said, I'm too busy, I've got a team behind me, and we're going to continue processing the applications for as long as we can. Please do not be one of the last people that submits their application on Monday and says, hey, John, I really need you to get this to me by 4 o'clock so I can get it uploaded. We will do our best, but I cannot promise anything. I cannot promise. So you need to get your information in now. Click that QR code, Tony. It is called Summit Home Now, and that is how you get started. Ladies and gentlemen, I appreciate you listening. I appreciate your trust. I appreciate you subscribing to my YouTube channel and following me so that you get more information. I'm going to be teaching a lot over the coming month as we're waiting for vouchers to be released and help to educate you and to earn your business. So thanks so much for listening, and everybody have a wonderful evening. Good night.